Welcome back to the Deep Dive. Today we're tackling a really significant topic, opening up a stack of source material on, well, the whole financial life cycle of real estate investment.
Yeah, it's a big one. We're looking at everything from high-stakes strategies and market volatility to the psychology behind it all.
And crucially, the practical roadmaps for recovery. How do you get back in the game after a setback? That's what we want to analyze today.
Exactly. It's the full spectrum, isn't it? From using serious leverage, trying to get those big returns, all the way down to the, specific, sometimes creative tools someone needs to rebuild wealth. Sometimes from, well, less than zero.
Right. And the sources we have aren't just about diagnosing failures in big systems.
No, not at all. They actually give us the mechanics, the how-to for an informed person to reset. Doesn't matter if you're a seasoned pro or just thinking about buying your first home, looking for that long-term security.
I think that perspective is so important because financial security, it feels huge, right? Overwhelming. Makes you think you need that one big win, that home run.
We're sort of conditioned to think big, yeah.
But the math, pulled straight from our sources, tells a totally different story, almost counterintuitive. And it's a lesson for anyone focused on long-term wealth right from the get-go.
It really is. It's that core idea accumulation. Massive long-term success, it rarely comes from massive short-term actions. It's more about atomic habits, as some put it.
Atomic habits, right?
Yeah, the idea is simple, almost deceptively so. If you can just get, say, 1% better in a key financial area, just 1% every single day for a year.
Okay.
The compound effect, it transforms that tiny daily effort. You end up nearly 37 times better off than when you started.
37 times from just a 1% daily tweak.
Right.
That seems incredible.
Yeah.
But how do you actually do that? How do you measure a 1% improvement in finance every day? It can't just be watching stock tickers, right?
No, exactly. It's not about grand gestures. It's about the systems you put in place, that 1% improvement. It might just be spending 10 minutes each morning with your net worth tracker, finding one small recurring cost you can cut.
Okay, like a subscription you forgot about.
Precisely. Or maybe committing to paying just $1 more than the minimum on your highest interest debt every single day. It's small, but it adds up. But there's a flip side, a danger the sources highlight too. If you get just 1% worse each day for a year, you slack off consistently, make slightly bad choices.
Yeah.
You basically decline almost down to zero, that buildup of tiny failures. It's way more destructive than one big mistake.
Wow.
So that principle, that consistency, it really has to be the guide for any financial rebuilding effort.
Okay, so let's kick off this deep dive by really nailing down risk, because risk is, well, it's the currency of this whole conversation, isn't it? Especially when you add leverage and real estate into the mix. What's the technical definition we're working with?
Right. So fundamentally, investment risk is the chance that the returns you expect from a security just don't happen. Specifically, that the price of whatever you're holding actually falls. It's often described in the finance world as kind of an elusive concept. It's not just about the probability of losing money, but also the uncertainty around how much you might lose and when.
That really highlights the contrast we see in the material, comparing those high-risk investments, maybe like a volatile tech stock, with things that are seen as practically zero risk.
Exactly. Think about the classic low-risk anchor, a one-year treasury bill. You buy it, you hold it. The U.S. government pretty much guarantees you'll get your money back plus a fixed return. Historically, maybe, 2% before taxes?
Sounds safe.
The chance of default is practically nil, but, and this is key, there's still a risk hiding there. Inflation risk. If inflation is running at 5%, your safe 2% return actually means you've lost 3% in purchasing power.
That's a crucial point. The risk isn't just losing the initial money, it's losing real value. Now, for decades, the academic finance world kind of assumed investors were rational, cold, calculating, utility maximizers.
Yeah, that was the bedrock, wasn't it? Classical finance theory. The idea that market prices reflect all available information because these rational players are constantly finding and fixing inefficiencies.
But then came the behavioral economists.
Right. Most famously, Daniel Kahneman and Amos Tversky. And they didn't just question that core assumption of rationality. They pretty much shattered it.
How did they do that?
Through really rigorous studies, experiments that could be repeated. They show that people are, profoundly irrational. We're subject to all these predictable cognitive biases.
And proving that humans aren't rational. That had huge consequences, right? It basically spawned the whole field of behavioral finance.
That's absolutely monumental. And what's interesting is how their background or lack thereof in traditional economics, might have played a role.
How so?
Well, they came at it from psychology. They introduced concepts like prospect theory. That theory shows we feel the pain of a loss about twice as strongly as the pleasure of an equal gain. Loss aversion, they called it.
Okay, loss aversion. I can see
Oh.
that.
And just that one finding, it explains so much. Like why investors cling on to losing stocks way too long, just hoping to break even instead of cutting their losses like a rational calculation would suggest.
Makes sense.
The fact that Kahneman, a psychologist, ended up winning the Nobel Prize in economics for this work, sadly, after Tversky had passed away, it just showed that understanding why we make mistakes is now totally central to understanding how markets actually work. Our emotions, our mental wiring, they actively drive market swings and, frankly, irrational prices.
Okay, so if we accept that human irrationality is a given, how do the big players, the high net worth investors, managing huge sums, often using a lot of debt or leverage, how do they try to manage the risk that come with that leverage? Structurally, I mean.
Well, they use some pretty sophisticated strategies. One key one mentioned is the risk parity portfolio.
Risk parity, what's the goal there?
The main objective isn't just chasing the absolute highest return. It's more about balancing the risk contribution from every single asset class in the portfolio. Typically, stocks are volatile, bonds less so.
So if they want higher returns, don't they still need more exposure to the risky stuff, like stocks?
Not necessarily concentrated in one area. The risk parity thinking is, instead of piling into, say, just tech stocks or just emerging markets to juice returns, which concentrates your risk, it's better to diversify really broadly across global stocks, long-term government bonds, maybe commodities, lots of different things.
Okay, broad diversification.
And then apply leverage, but apply it kind of uniformly across the entire diversified portfolio.
Well, you're using debt to boost returns on bonds and things that are normally considered safer. That sounds counterintuitive for managing risk.
Yeah.
How does that end up being less risky than just concentrating on high-growth assets?
Yeah, it does sound a bit strange at first. But because the portfolio is so diversified and it's balanced by volatility, the different assets often don't move together. They have low correlation.
Oh.
So if stocks crash, maybe the long-term bonds go up, and that cushions the overall blow to the portfolio. By adding measured leverage to this really spread out mix, they can boost the overall return without putting all their eggs in one high-risk basket. The risk exposure is dispersed, spread out.
Got it.
So for these sophisticated investors, strategically using debt can actually be a tool for managing how risk is distributed, not just something that magnifies potential failure.
That idea of high-stakes leverage being used for risk management, well, it leads us straight to the flip side. What happens when leverage is used recklessly? When it creates fragile systems and leads to widespread financial pain?
Yeah.
We've got some historical context here, specifically looking at the lead-up to the 2008 crisis.
Oh, definitely. It's a textbook case, really, of systemic fragility. You had questionable lending practices mixed with just pervasive leverage. The sources point to institutions like WAMU Washington Mutual.
WAMU, right. I remember them.
Before they collapsed, they had this enormous mortgage portfolio, something like $100 billion. On the surface, that size suggests stability, right? But underneath, the structure was, well, it was rotten.
What were the specific red flags in that $100 billion portfolio? What made it so unstable?
The sources really highlight one key thing. 60% of the mortgages in their entire portfolio had interest rates that were due to adjust within just 1 year.
60%? What?
Yeah, and these weren't all necessarily subprime loans in the beginning. Some were traditional loans, but with dangerously short fixed-rate periods. Imagine getting a mortgage at, say, 5%, thinking you're okay, but then 12 months later, bam, it resets to 8% or 10%.
That's a huge payment shock for the homeowner.
Massive. It exposed customers to this huge risk of sudden, completely unaffordable payments.
And if the housing market itself started to soften, meaning your home value wasn't keeping up with the loan amount, you'd be trapped.
Exactly. You're suddenly facing the real possibility of owing way more on the mortgage than the house is even worth. On top of that, WAMU was known for pushing loans with high loan-to-value ratios, sometimes up to 80%.
Meaning homeowners had very little equity, very little cushion.
Right, almost no buffer to absorb even a small dip in the market. When your financial structure is built on constantly rising prices and really short-term debt, it just ignores basic safety standards. Even a small headwind can cause a total collapse.
It's devastating for the homeowners caught on that. But the sources also point out that this kind of distress, this breakdown, it actually signals a major opportunity for a certain kind of real estate investor, the one looking for motivated sellers.
That's absolutely central to a lot of real estate investment strategies.
Mhm.
The best deals often are just sitting there on the open market. Investors actively hunt for public signals of distress. Things like bankruptcy filings, death notices, divorce records, and probably most commonly, foreclosure notices. These situations create an urgent need for the owner, or maybe their heirs, to sell quickly. Getting top dollar becomes secondary to just getting out.
So the distress itself becomes the starting point for a negotiation where the power balance is, well, it's shifted.
Definitely. It's a highly asymmetrical negotiation.
And the sources even detail the kind of approach an investor might take when talking to someone facing foreclosure. It sounds like a delicate conversation. You need to offer a solution without sounding predatory.
Yeah, it has to be framed very carefully. The investor needs to position themselves not as a vulture, but as a guide. Someone offering a clear path out of a really tough legal and financial spot.
How might that conversation go?
Well, an investor might approach the owner, acknowledge how difficult things are, and say something like, look, I want to find a way to give you some cash for the equity you still have, money you'll lose completely if the foreclosure goes through. If we work together now, we can stop the foreclosure, save your credit from the worst possible hit, you get some cash to help you move and reset, and you can actually start over without this massive debt hanging over you.
So the focus is on saving their credit and giving them a fresh start in exchange for the property at a discount.
Essentially, yeah. Saving their credit score and maybe some psychological relief in exchange for that distressed asset.
That whole tactic relies on the seller being in a desperate situation. Which brings us back to that market irrationality we talked about earlier. It wasn't just individuals being irrational. The whole market seemed to suffer from these collective psychological blind spots leading up to the crisis.
Oh, absolutely. The pricing we saw in the run-up to the subprime meltdown. It's probably one of the most staggering financial stories of the last 100 years. Investors who were betting against the market, the ones buying protection using credit default swaps, they found pricing that was just completely disconnected from any kind of objective risk.
And this involved those complex securities, CDOs, right?
Yeah.
Collateralized debt obligations. Can you just quickly refresh us on what those are?
Sure. So basically, a CDO is a big pool of debt, often mortgages, but other debts too. They bundle all these loans together and then slice the bundle up into different pieces called tranches based on risk.
Like layers in a cake.
Kind of, yeah. The top slices were rated AAA, supposedly super safe. The bottom slices, the equity or mezzanine tranches, were known to be the riskiest. The whole theory was if you pool enough loans, a few defaults won't sink the ship because the risk is spread out.
But that theory had a flaw.
A massive one. The rating agencies and the market itself just wildly underestimated the actual risk buried in those supposedly safe AAA and AA rated slices, especially when you considered that if one mortgage defaulted, others like it probably would too. The diversification wasn't as effective as they thought.
And the pricing reflected that delusion.
Totally. It was irrational. The market was charging 4 times less for insurance, the credit default swap on a supposedly safe AA slice of a CDO, than it charged for insurance on the openly risky BBB slice. Even though realistically, the risk in those higher rated slices was way, way higher than anyone was admitting.
4 times less. That's wild. What was driving that mispricing? Was it just greed or something deeper?
It seems like it was a profound psychological failure, amplified by flawed math models. The market players, the institutions, they seem to believe that a total collapse of the subprime market, where most of those mortgages failed, was basically impossible because the consequences would be so catastrophic for the global economy.
So the sheer awfulness of the potential outcome made them think it couldn't happen.
Paradoxically, yes. They operated under this comfortable assumption that something that terrible just wouldn't be allowed to occur or couldn't statistically happen. The rating agencies put the odds of those AA slices defaulting at something like 1 in 200.
But the real odds.
Internal analysis later, like the kind highlighted in The Big Short, suggested the true odds, considering how defaults were correlated, were much, much higher, maybe closer to 1 in 10. The market's fear of the outcome blinded them to its actual likelihood.
That's a chilling lesson. Just because a disaster would be horrific doesn't make it improbable. And that brings the human element right back again. the challenge of recovery, of reentry after that kind of storm.
Right, and that realization, that human element, it's the perfect pivot point for us. Because whether you're recovering from a huge shock like the '08 crisis or you're just stepping into the market for the first time, the principles for successful reentry, they really center around guidance and clarity.
This is where the sources emphasize that idea of not trying to be the hero yourself,
Yeah.
but finding a guide, like the story brand principle.
Hmm.
Customers aren't looking for another hero. They need a guide who knows the path.
Exactly. And the value of that guide lies in their specific superior knowledge. They clarify the path, they help you avoid wasted effort and money. Think about a really good real estate agent, or maybe a mortgage advisor who specializes in helping people rebuild. Their knowledge is way beyond the average person's.
They know the little things that make a big difference in these leveraged deals, like
Yeah.
should you spend money fixing up a place before selling, or just sell it as is?
Precisely. A good guide knows the local market. They know if fixing minor issues or doing cosmetic upgrades will actually pay off in a higher price, or if you're better off leaving that money in your pocket and selling it as a fixer-upper bargain. Crucially, they understand the nuances, neighborhood pricing trends, potential appraisal gaps, how to structure an offer that actually gets accepted when things are competitive. They're constantly optimizing based on real-time market knowledge, which is something an amateur just doesn't have.
Okay, so specialized knowledge from a guide is vital. But like we said at the start, knowledge alone isn't enough. You need action, consistent action. So let's talk about building those small habits for the rebuilding phase.
Yeah, this is where we circle back to those atomic habits principles, applying them directly to financial recovery. Changing behavior, especially around money, it's really hard, mostly because our goals tend to be too vague.
Like save more money or invest better.
Exactly. Those are hard to act on. The system needs habits that are specific and clear. You need what they call an implementation intention.
Okay, an implementation intention. Give me an example of what that looks like for finance.
Okay, so instead of the vague goal, save more, you create a specific plan tied to a cue. For instance, when I get my paycheck notification email on the 1st and 15th, I will immediately transfer $100 into my high-yield savings account.
Ah, okay. The email is the cue. The transfer is the specific action.
Right. That specificity removes the friction. You don't have to decide when or if you'll do it. The time to act becomes obvious, almost automatic.
And sticking to those small, specific actions daily or weekly, that's what separates successful rebuilding from just staying stuck.
Oh.
It also seems connected to overcoming procrastination, right? Not waiting until the deadline looms.
Absolutely. That connects perfectly to the 12-week year concept from another source. It forces a total mental shift away from thinking in terms of annual goals.
12 weeks instead of 52.
Yeah. You narrow your focus dramatically. Then you break that 12 weeks down into weekly goals and, critically, into daily actions. It just eliminates that mental space where you think, oh, I've got plenty of time.
Right, the I'll start next month trap.
Exactly. If you only have 12 weeks to hit a key target, maybe saving that down payment chunk or clearing a specific debt, you have to take immediate daily action on the things that matter most. It naturally pushes you towards that 1% daily improvement we talked about earlier.
That kind of focused execution suggests that maybe for navigating something complex like real estate, broad knowledge is more useful than super deep specialization in just one tiny area.
That's a really interesting contrast the sources draw. Traditional education often rewards knowing more and more about less and less, right? Hyper-specialization. But the mindset for financial freedom, as someone like Rich Dad might put it, is more about knowing a little about a lot.
So understanding the whole financial picture, not just your narrow lane, what does that broad financial education look like in practice?
Well, it means understanding the key differences between the main types of income. Earned income from a job, passive income from things like rentals or businesses you don't actively manage day to day, and portfolio income from stocks, bonds, paper assets. It's about getting good enough at investing so your money starts working for you. And crucially, it means being financially literate enough to sit in those meetings with your banker, your lawyer, your tax advisor, your broker, and actually understand what they're saying.
Understanding the jargon, the processes, the implications.
Exactly. If you grasp the basics of how debt works, how legal structures protect you, how taxes impact everything, you're not just blindly trusting one expert anymore. You become the ultimate guide for your own financial future.
Okay, let's shift into the practical tools for getting back in the game. Especially for someone, an investor, or maybe a homeowner, who lost capital in a downturn and now faces real hurdles getting started again. How does real estate itself offer ways to use creativity instead of just cash?
This is really where real estate investing shines, I think, compared to, say, the stock market. If you don't have a lot of capital for trading stocks, it can take ages just to build up enough to make meaningful moves.
Mhm.
Real estate's different. It lets you leverage your time, your ingenuity, your knowledge to basically substitute for having a big pile of cash. That's the essence of creative financing, finding ways around the traditional bank loan model.
So if the big banks are often tied up by regulations, Fannie Mae, Freddie Mac rules, what are some effective non-traditional financing tools for someone trying to re-enter the market?
The sources point to two big ones that offer a lot of flexibility, using private money and negotiating seller financing.
Okay, let's start with private money. What is that exactly?
So private money is basically cash you borrow from individuals, not banks. These are usually non-professional lenders, maybe someone with savings who's looking for a better return than they can get from a bank CD, which might only pay 1% or 2%.
So it's like a peer-to-peer loan, but specifically for real estate. How does the investor actually get this money? Does the lender just trust them?
It's less about trusting the borrower's credit score and more about trusting the asset being purchased. The security is key. The private lender gets proper documentation, a promissory note saying, I owe you this much, and crucially, a mortgage or deed of trust recorded against the property, usually in first position.
Meaning if the investor defaults.
The lender gets the property. That's their security. These deals often have shorter terms, maybe higher interest rates, perhaps 8%, 10%, 12%, but the advantage is speed and flexibility. You can close a deal quickly, often snapping up a distressed property before traditional financing could even get approved. That speed can make the higher interest cost totally worth it. It's fast capital from people, not slow capital from institutions.
Okay, that makes sense. And the other one was seller financing. That sounds like the most direct negotiation.
It's incredibly powerful, especially if you're short on cash. When you arrange pure seller financing, you bypass the bank completely.
No bank involvement at all.
None. Which means you sidestep all those rigid requirements from Fannie Mae and Freddie Mac. They're the ones setting the rules for most conventional loans. Things like strict debt-to-income limits, needing 20% or even 30% down for investment properties.
Right, those rules are tough for someone rebuilding. Why are they so strict?
Well, Fannie and Freddie buy up most of the conventional mortgages originated by banks, so they get to set the standards, minimum credit scores, maximum loan-to-value ratios, how much debt you can carry. It standardizes things that makes it inflexible.
So seller financing avoids all that.
Exactly. You negotiate directly with the homeowner. It becomes a private contract. Maybe it's structured as a seller carryback note where they essentially act as your bank, or maybe an installment contract. You agree on the terms together, including potentially a very low down payment, maybe even zero down in some cases. The seller becomes your private lender. For someone re-entering the market, getting around those standard down payment hurdles, that's huge.
That flexibility is definitely the payoff for learning these creative techniques. Okay, so let's say someone uses these tools, starts rebuilding equity. Now let's talk taxes. Specifically, strategic tax optimization to help keep more of that equity. Depreciation seems key for rental property owners.
Oh, depreciation is a massive benefit. It's one of the best annual tax tools for real estate investors. It's technically a non-cash expense.
Meaning you don't actually spend money, but you get a deduction.
Exactly. It allows you to deduct the theoretical wearing out of the building itself, not the land, just the structure over its official useful life. For residential rentals, that's typically 27.5 years using what's called the straight line method.
But hang on, isn't depreciation kind of an accounting trick? Because it lowers your cost basis in the property. Doesn't that just mean you pay more capital gains tax when you eventually sell?
That's the trade-off. You're absolutely right. And a smart investor understands that. Yes, it lowers your adjusted basis, which can lead to a bigger taxable gain down the road. But the benefit is now. It provides an immediate annual deduction against your current rental income.
So shelters today's income from taxes.
Right, which increases your cash flow today. You have more money in your pocket right now, which you can then use for more investments, paying down debt faster, whatever helps you build momentum. You get the tax break when you might need the cash flow most.
Okay, that makes sense. And speaking of tax rules, there's that one surprising loophole mentioned for homeowners, or even vacation homeowners, that savvy people sometimes use to generate cash quickly, tax-free.
Ah, yes. The 14-day rental rule, sometimes called the Masters loophole or the Super Bowl loophole because people use it when major events come to town.
How does it work?
It's pretty straightforward according to the IRS rules mentioned in the sources.
Yeah.
If you rent out your primary home or even a second home for 14 days or less during the entire calendar year,
Yeah.
you get to pocket all the rental income completely tax-free.
Wait, all of it? It doesn't matter how much rent you charge per night.
Nope. According to the sources, the dollar amount is irrelevant. If your house happens to be near a massive event, like the Super Bowl or a huge convention, and you can charge premium rates, let's say, hypothetically, $10,000 a night for those 2 weeks.
That's $140,000.
That entire $140,000 in gross rental income could be exempt from federal income tax. The key is strict adherence. It must be 14 days or fewer, go 1 day over, and the whole thing changes.
Wow. That's a significant, though temporary, way to generate a chunk of tax-free capital.
Absolutely. A potentially powerful tool for a quick cash infusion.
So we've covered a lot of ground today, from defining financial risk and seeing how human psychology messes with markets, to the brutal reality of market collapses, and finally exploring these creative tools for rebuilding financial security.
Yeah, and if you look across all these sources, a few core themes keep emerging. Understanding risk, especially psychological risk. Mastering leverage and creative financing. But maybe most importantly, that power of small, consistent improvements over time.
It really seems to boil down to focus and commitment, doesn't it?
I think so. We saw how entire markets arguably failed because of this collective psychological block refusing to believe a catastrophe was possible just because it was too awful to contemplate.
Right.
But for an individual trying to recover or advance, the lesson is really about your own trajectory. It depends on your ability to stay committed, even when it's uncomfortable.
Choosing that commitment mindset over the comfort mindset, as one source puts it.
Exactly. The commitment mindset means you actively choose pleasurable results over pleasurable activity. It's so easy, isn't it, to trade the long-term benefits like compound interest really taking off or getting out of debt faster for short-term ease or comfort.
Yeah, avoiding the temporary pain of discipline.
Right. Avoiding the discomfort of that disciplined work, that 1% daily effort, learning the jargon, structuring the creative deals in favor of what feels easier right now. So as you're rebuilding or just trying to get ahead financially, you constantly face that choice.
Am I willing to embrace the temporary difficulty, the hard, focused work, to get that sustained long-term result of financial freedom?
That's the question. That difference in focus, that willingness to prioritize the future benefit over today's comfort, that really is the ultimate leverage, isn't it?
It seems like it.
It really is. We talked about leveraging time and creativity to make up for lack of capital. That takes daily grind, that 1% effort, but it has to be backed by real commitment. Keep your eye on the vision who you want to become financially and let those consistent small actions bridge the gap between where you are now and where you truly can be.
That was the deep dive. Thank you for joining us.